Good morning. We'll get started in just a couple of minutes here, just letting some folks into the room. Has everyone RSVP'd to the birthday party? I see some nods.
I have to work. I was so sad.
That's a good excuse, QT.
Yeah. But I'm talking from Iguazu in Argentina right now.
Oh. I feel like I always kick off this meeting with my news. So does anyone have any good news that they'd like to share with this group to get started? And I'll jump into my boring announcements. You guys are shy today. What did we talk about this shyness? Didn't we say we were gonna cut that out?
First time Ellen and I are sharing a screen, so that's news.
All right. Okay, so since we're 1 minute in, I'm gonna go ahead and just do announcements and keep letting folks in the room as they trickle in. So the birthday party is on Tuesday. It is, hold on, that's the wrong link. It will be a great time. It'll be the first time the industry has really come together since the pandemic has started. Our last big event was October 2019, which is really crazy to say out loud. So if you all are available for that, it's just going to be a great fun event. And some of you are also in our auction items. So excited for that. We've got some, honestly, I was putting our master list for auctions together yesterday, and it's really cool. One of the things I'm really excited about, so Franklin Barbecue came out with a new line of grills, and they are sending us one of those new grills, as well as all of their, all the things you might need. So all of their sauces, all of their rubs, their butcher paper, a couple of different knives. So I think that one's going to be a pretty popular one. Some of the other auction items are things like, a year's free of Richard's rainwater, a year's free of Poppy beverages. So yeah, I hope that I see you all there. And then I know that Debbie was a little bit behind getting these recordings up, but all of those are up on the portal now. So I'll link that in the chat here after I'm done talking. But before I close out announcements, does anyone have any questions? I'm a little bit behind on my email just because of the birthday party. So I just want to make sure I save a little bit of room here if anyone has any questions about anything. No? Okay, good. So I'll link out the portal here in just a second. And so I'm excited for all of you to talk to Jim Shehigian from Ion today. Jim has built, led, successfully exited multiple companies over the last 30 years, and he currently leads the credit financing business at AionFI, where his team has really been supporting the growth of natural and organic CPG and food companies for the last 10 years. So he's just a great resource as far as fundraising experience, coming at it from a founder's perspective, but also on the credit side can really support the conversation about getting that support or getting you that support as well. So I'm going to turn it over to Jim, and then we'll do the usual thing where we open it up for Q&A. So take us away, Jim.
Great, thanks, Christina. So thanks all for spending the time this morning. And if some of you were on the panel discussion yesterday on Zoom, a little bit of what I'll say is repetitive, but I'll assume most of you are building companies either early stage and probably either pre-revenue or certainly pre-profitable. And most of what I say will be applicable to any natural and organic CPG or food company. There's a couple nuances around food that I'll talk about as well. But in general, this idea of funding your business, this is the point I made yesterday. It needs to be as intentional as everything else you do in your business, the ingredients you put in your product, who you choose, the co-founder, because even if it's for a short duration within the life of your company, the people that are financing you are your partner in it. And so, like anything else, you want that to be something that shares your values and your objectives. The first thing I would say, and you may not have the entire vision of this yet, but as founders, never lose sight of what you want your eventual outcome to be, because that will influence who you end up approaching for funding. And what I mean by that is some people want to build up a company as fast as they can and get their product on every shelf imaginable. Some want to do it in a more deliberate way, but they're building perhaps even bigger enterprise value, and they're gunning for an exit in a couple of years or a few years. And some are building companies because they want to pass them down to another generation or keep them local. And so I'll go through each of the ways you can fund these things and kind of talk about what's good and bad for those different objectives, because they are a little bit different. Most companies, and so we'll start at the basics, most companies start either as self-funded. You as founders are taking some salary or no salary or working 2 jobs or putting some savings into it, or there's family and friends that have helped you do a stake. And then you may need to do what's called a seed round, and there's a couple of options for that. One example I'll walk you through, and I kind of did this halfway yesterday, but one of our clients that loves us talking about them is Purely Elizabeth, the breakfast food company that's now all over the place. And you may have seen Elizabeth Stein, who started that company here in Boulder, where I am, had so far in 2022, I think the second biggest private capital raise in the country. Men, women, founders, doesn't matter. So she started that company, much like you all, about 7 years ago, I think, at her kitchen table. She then got distribution in a couple of the local natural and organic grocers here in Boulder. And at that time, Whole Foods was running their Rocky Mountain region out of Boulder, and they started a pilot. And a lot of the companies we work with in our firm, which is a little later stage than what I'm talking about, they have, someone asked what that raise was. It was $50 million. So one of the things that happened to her, and this happens a lot, she was planning on growing, and her objective, and she was very focused on this from the start, she wanted to grow as fast as she could while maintaining equity control of her company. That's sometimes the right answer. If you want to grow really, really fast, sometimes you do something with venture capital and sell more of your shares earlier, but that gets you out there faster. For her, she knew herself, and she knew it was important to maintain equity as long as possible. So, and I'll talk a little bit, we funded her because that's later than where we are right now, but she went through steps that allowed her to maintain that until she was on every shelf in the country, and then did sell a piece of her company for a great deal more money. So the point with that is, know what you want your outcome to be. You don't have to know all the details, but people are going to come at you with a lot of different ways to fund your company, and you want to have that lens because it's overwhelming. I mean, I don't think tell me if I'm wrong, I don't think any of you started your company because you want to be a chief financial officer or a financial strategist. What I see most often with founders is that the finance piece is something they do late on Sunday night after they've put the kids to bed, and they're thinking about till 2 a.m. what's going on Monday morning. And they get on their banking portal and their books are all over the place, and they're trying to figure out QuickBooks for the first time sometimes. That isn't the best approach. You really do, from the very beginning, have the same discipline. And it doesn't take a lot of time, but you want the discipline. And if you need help, get help to keep your books up to date and in order. None of the funding rounds, maybe except for family and friends that I'm going to talk about, will really go well for you unless you've got a good handle on your numbers, where you stand, and why you think your projections for what money you need make sense. So you started out funding it yourself, or got some family and friends money, or maybe you're just still doing this part-time while you figure out your concept. You can then say, all right, now beyond me and my co-founder, we've got to hire, maybe it's just a contractor, but we've got to hire a technologist, or we have got to start working with a food scientist or a blender and do some trials, or we've got to get some help in getting various regulatory approvals. All those things cost money. And so you then do what's called a seed round. And a seed round, probably more often than not, involves one of two things. Still mostly equity. So still you're saying, you know what, I'm going to give you a little piece of the company, and then you stake me some money to get to the next stage. There are some options for pre-seed or seed rounds in the debt space as well. People are familiar with the SBA, the Small Business Administration loans. At the stage that you're at, that's probably the only way that a bank would even talk to you until you're in business a couple of years and probably profitable. Very tough to get bank financing. But the last thing I'll say before we start going through the steps is most businesses that have a successful outcome understand how to use both equity and debt. If you were on the call yesterday, I think except for me, everyone was pretty much talking about equity raising, meaning, whether it's VC, whether it's private equity, whether it's an angel investor, it's all the same thing. Basically, you're selling some shares in your company and they are buying them from you, and you're using that money to grow the company. We're all taught when we grow up, you don't want to carry a lot of debt, maybe except for a mortgage on your house. Business is a little bit different. There are times when debt makes a great deal of sense. I gave you the example of Elizabeth Stein with Pure Elizabeth. For her, it was maintaining control of the company. Sometimes it's because you don't have 6 months to close a round. You've got to get something in place quickly. And debt can often be done more quickly than equity. But to get yourself going, you'll find some people that can invest in you. One thing, an angel investor is merely someone who's called an accredited investor. If you don't know that term, that's an actual federal regulation. And it means that if an individual has $1 million or more outside of their primary residence in investable assets, they're considered an accredited investor. What that means is you don't have to go through all of the regulations that you would if you were raising money in the public markets or with a VC firm. There's a lot of paperwork, a lot of disclosures, a lot of legal costs in getting all the documentation. But an accredited investor can bypass most of that, because what's assumed is, okay, if you've accumulated that much money, you know enough that, any of you on this call selling them some stock, you're not taking advantage of them. So that's what that's about. If you're going to approach angel investors, you want to always start with people you know. And if you don't know anybody to approach angel investing, then most cities, and I know there's a ton of these in Texas, we have one of the biggest ones here in Colorado, angel investing groups, because angel investors often are learning how to do this too. They may have cashed out of their company and now they want to start helping people like you folks. And so the angel investing group pulls them all together, teaches them how to evaluate companies, so that when you come to them and pitch your company and say, I'd like some investment, they understand how to evaluate that. And that group's whole job is to take promising companies like yours and put them in front of groups of these angel investors. So whether it actually goes and you get money from them or not, I would encourage you to get involved. Here in Colorado, in fact, they're just running it next month. They have something called the Hyper Accelerator. So they take 5 companies like all of you are running, or pre-revenue, pre-everything. They take them through a 5-day program and teach them how to do your financial model, how to talk to investors, literally everything, how to figure out product market fit. And I know you've spent a lot of mind share on that, but you need to learn the way your investors think about it too. So it's great to approach those groups, and they expect that folks like you are probably doing this for the first time, and they don't expect you to come in there and be, Warren Buffett level financially sophisticated. So I would encourage you to do that, whether you end up doing an angel round or not, but it is one of the quicker ways that you can get going. Now, downsides of angel investing. It's great at this stage that we're talking about right now. I actually took over to run a company once that never really stopped raising money that way. They got up to $10 million in revenue, and they ended up with over 135 different angel investors on their cap table. And the CEO, still a good friend of mine, she spent all of her time on investor relations. And so you don't want to, you do need to graduate from that at some point if you continue to show traction. If you do start to show traction, you will start to have a target painted on your back, because one thing that's great news is, compared to even 3 years ago, the growth potential and the importance of natural and organic products, CPG, food, all kinds of things, energy production, is just booming. Another change is investor families are turning over. You may be familiar with the term family office. If you're not, a family office is where an ultra high net worth family, typically 100 million or up, has a private investment firm that just works for them. It's like their own office staff. And all they do is manage that fortune. And I spent about 25 years of my career in that space. And I funded the first company I was working with those kind of investors. When you perhaps meet, and they may even come to this birthday bash, you don't know. What I am seeing is that I apologize a second. I just got a message. I just need to do this. Okay. Those generations are turning over. And so there's younger generations taking over, even some of these very old famous fortunes that you would have heard of. They care a whole lot more about what companies like you are doing than their parents probably did. And they are consciously investing those fortunes in companies that are doing good for the world. So we'll talk about that a little later, but I wanted to get that definition out of the way. So you've got your angel round. You perhaps, you're certainly not profitable at this stage, but you are pre-revenue pre-cash flow positive. You're getting maybe some revenue, maybe you're doing some test selling in a few local places. And what you want to do is continue to stay on top of your projections, continue to say, well, I've got these 3 proof points. It's selling, faster than anything else in the category on these shelves here. And so now the pitch starts to change a little bit. What happens is you're now starting to prove up the value to the world of what you're doing. And you want to be able to have a set of proof points so that when someone is now going to give you probably more money because you're growing, you're not inventing everything from scratch at this point. They still don't expect you don't have everything figured out. But people start to invest in you once you are starting to sell a product because they want to see you do more of that. So when I keep using the term projection, now it starts to go all these terms you hear around margins and growth rates and distribution. And it's never too early to start getting a picture in your head on all of this. It is overwhelming. And what I told the group yesterday is find some advisors. We got some good advice from Isabella on the panel yesterday. You don't want to just let the advisors make your decision for you, but you do want to get some diverse perspectives. And they got to be more than just people like me who actually do the financing. You want some people who have done this and they don't have any skin in the game. Get both perspectives, because that'll help you decide when you go to the next of these steps. One thing that you shouldn't rule out is vendor terms. So at your early stage, everyone's going to probably want cash on the barrelhead before they sell you anything. But as you start generating cash flow and as you're their customer in a small way, month after month after month, do not be shy about saying, hey, I'd like to now talk about whether we can get 45 days terms on you. That's basically another way of financing your business. You're now starting to stretch things out. You can't do that forever, but at the early stage, don't forget to talk about that with your vendors. Now, this is where debt may start to come in. A lot of times, and this is really actually why my firm was created. You've gotten to the stage that I'm talking about. The amount of time can be anywhere, but you've gotten to that stage. And if it's continuing to go well, you will probably get a step change in how you grow. In the case of Elizabeth Stein over at Purely Elizabeth, it was that going from, and again, she doesn't, I don't usually talk about this, but she actually loves getting the story out. Few $100,000 to boom, $3 million order. And this is where debt comes in. There are not a lot of options for debt financing at that stage, other than what's called convertible debt. And convertible debt is where someone will basically loan you the money. And this can be into the millions of dollars. But what it is secured by is stock in your company. And it usually, the note will convert sometime between a year and 2 years is most common, somewhere in there. I mean, there's shorter and there's longer ones occasionally. If you don't pay it back, the debt converts to a predefined amount of equity, which means you've now given away shares for that loan. Sometimes that's not a bad idea if you really need to get going fast. And remember, I said one of the ways to think about where you're heading is grow as fast as possible. Companies doing that can often do this at some point. But again, you want to get advice and be intentional about it. You want to have a good securities lawyer that works with startups. They'll advise you on a lot of this stuff, even though they're not, primarily a financial person. But that's an option that you can use. The downside is you may end up losing the majority of your company or losing a whole lot more at a very low valuation than you want to. So another option, if you do start getting receivables, you're now selling and you're sending out invoices and people are buying your stuff at whatever level, there are two ways you can finance those. The traditional way goes back to the Renaissance, actually. It's called factoring. And there are firms out there where you can say, I've got this invoice for $300,000 from Natural Grocers, and I want to borrow against that because I have to ship the product in 30 days. They don't pay for 90. I need to get the money now. That's what factoring is. And you do that invoice by invoice. Upside is it's pretty quick, doesn't take a lot of underwriting. Downside is it's expensive. It's expensive money. And when I say expensive, I mean 20, 30% or more interest, sometimes even more. And it's paperwork intensive, and you're doing this invoice by invoice by invoice. And you don't have a lot of time as a founder. You have no time. So, something that takes a lot of administration is a pain in the neck. But sometimes for a short period of time, you can do that. A nice thing about it is you can get in and out of it quickly. You can do one and never do it again. That's all fine. What we actually created, and we did this because we had all been founders, is we saw this situation. You start being successful. I don't need 30 grand a month for raw materials. I need $3 million. I need $300,000, whatever it is. And I'm selling, that level. So what we created is something that is called asset-backed credit lines. So we are also loaning against your invoices, but because we're a fintech, the invoices flow through our system and you just go on there and you upload the invoices and you advance at your contracted advance rate. So let's say I've got an invoice for $300,000 from Natural Grocers, goes through our system and you press a button and you can borrow 80% of that and it's wired to your account. And the system keeps track of all of it. There may be a couple companies doing it. We kind of invented this actually back in 2013. So we built the tech for it. So that's an option. And one reason we do so much in the natural and organic space is because that story of Elizabeth Stein happens over and over and over again. And what traditionally happens to founders is you get the $3 million order from Whole Foods or US Foods or KeHE or whoever the distributor is. And you jump right to what you've always heard about since you dreamed of being an entrepreneur. I'm going to go get VC money because they do give you millions of dollars. Well, challenge there is if you do that early, your company is not worth what it's ultimately going to be. So let's say you go to a VC and they say, I'd like 40% of your company and I'll give you the $3 million. Well, do the math. You've now sold your company for, I think, about $11 million. You said that the whole thing is valued 11, 40% of it for that. A couple of years later, when you're much more successful and you're doing $30 million a year in revenue and you sell it for a multiple of 2, 3, whatever, you sold your company for 70 million bucks. That VC has 40% of 70 million bucks that you don't have as a founder because you did that really early. So you'll hear through the life of your business, people talking about valuations and percentages and all these things. However you do, and it's not simple if you've never done it. However you do it, find a lawyer, an accountant, somebody to take you through that. You have to have that picture in your head. Otherwise, founders can have awful surprises at the end. They either don't control their company anymore, or they don't own as much of it as they wanted when they do the exit. And this isn't all just about money, but we don't all do these things just for money. But if you don't be intentional about this, you won't get the outcome on the money part either. So that does not mean VC or PE are bad, but we'll get there in a minute. So now you're going and you've either found a lender like us, or you maybe have found a government program that lends to people in very specific niches. Like maybe you're doing a, a product for better nutrition in schools. There may very well be a agriculture department or FDA program that wants to provide seed funding for people working in that space. So never rule out government grants, programs. I know companies here in Boulder that's how they funded things for the first 3 years. Not just in this space, a lot of them are in aerospace here because NASA's spending money like water. So that's another avenue, don't rule out. Specifically, if you are distributing to one of the large, I don't think KeHE and US Foods do this so much, but Costco does, Amazon does. You have the ability sometimes to almost do a version of factoring right on their platform. So let's say you sell, I don't know, $200,000 of product up to the Amazon store. They're not going to pay you for whatever it is, 30, 60, 90 days. If you need to get the money right away because you got to buy the next round of raw materials, you got to do the next marketing trip, whatever it is, you can basically make a bid on their platform. So the vendor portal is important. And you can say, all right, I'll take 94% of what I billed you for if you can pay me in 3 days. And then you can do that. And you can make that trade-off one at a time. So again, like factoring or doing debt, it's far less of a permanent commitment than selling equity, which is angel round, private equity, venture capital. That's why you hear me saying, think about these things as progressions. As your business grows, the right tool for financing that particular month or that particular year changes. But the pros and cons I'll kind of shake out as I'm describing. Does not mean that PE and VC are bad. It just means you do them really early, don't necessarily get a good outcome. Now, one reason you might want to look at VC particularly, or PE also early, is because, well, let me stop for a second. All money spends the same. All money is green. So two things you don't want to do is just assume, I need $1 million because this person's in front of me and said, I love what you're doing, I'm going to give you $1 million. That's backwards. Know what you need, and then you find that, because people will do that. People are trying to invest money. They want to get a return. Just because the money is available doesn't mean you should take the amount they give you or on the terms. You have to know that first. Then you shop it. And you'll hear me and everyone else probably you talk to that it takes 90 to 100 presentations to get a couple of term sheets when you start selling to VCs or private equity firms. It's a lot of work. That's part of the reason I'm telling you don't do it right from the beginning, because it'll bury you when you're focused on just getting your product right and getting your team built and all of those sorts of things. But you will get to a stage where you need money in the amounts that private equity or venture capital can get to you. And you're still at a stage I'm describing now where you're not profitable. So you still can't necessarily walk into a bank and get a normal business credit line. And there may be some special programs, but you're not going to be able to borrow millions of dollars usually because they have very strict rules. So you start pitching to VCs. The things to understand about venture capital, and I'm not an expert on venture capital, but the basics are they create funds that last for 10 years. They put money in a lot of companies, and they expect only a couple of them to be the home runs and basically make up for all the ones that flame out. So the good news is that they understand not every company is going to be successful. They make quick decisions. So you don't usually, for anyone that's any good in VC, you don't wait months for them to tell you, no, I'm passing, because they know the kindest thing to do to you is say, I can't help you now, so that you can continue to move on. Anyone who's dragging it out and saying, well, I'm not sure, they're not who you probably want to work with. The point about that 10-year fund is they have to be out of it in 10 years. It's kind of a tax structure thing. So you have to realize they've got a clock running on your business. Remember at the beginning, I said, think about how you want this journey to go. If you want to be working in this until you retire, or for the next 10 years, then a VC may not be the first place to go because they need you to cash out, and they will be on your board most likely, and they will start imposing how you run all these books and records, which I was saying, start to learn how to do that really early. They will, in some cases, dictate when you exit and for what terms. Now, that's not a bad thing if you pick the right VC. That can just have you have a home run. But while all money is green and all money spends the same, all VCs are not the same. You definitely, for the world that you're all working in, you want to find equity investors like a venture capital firm that understand this space and are committed to it. Not just that they did a deal because they want to have an ESG investment in their portfolio. A lot of times the VCs have actually cashed out themselves from firms like this. They love the industry. They are mission driven as well. Doesn't mean they're not hard-nosed finance people, but they will understand the journey you're on. They'll already know that, okay, your distribution strategy involves Costco. Well, I know now what they're going to demand of you in terms of marketing clawbacks, invoice dilution, all that stuff. So there are firms out there, and some of them work with some of our customers. There's a guy named Andy Whitman, runs a firm in Chicago and Boulder here called Loft Partners. There's a bunch like that. They are people that if you have them on your board, they are your champion. They understand this space and they can make lots of connections. That's why you don't want to go to a VC who primarily does tech companies, for example. They will have some connections, but for you, you need an investor who has taken 5 other companies through the entire Whole Foods to IPO even journey. And so that when you as the CEO are talking with this guy who's now on your board and you say, well, my challenge is I've got to find a CFO that can structure this thing so that we can sell it. Or I need to find the sharpest marketing person for organic hair and makeup that you can find, or whatever it is. That kind of investor has that network. So money is all green, spends the same. Your investors are not all the same. You want smart money. And this is not just me. I mean, probably anyone who knows this stuff will tell you a version of that same phrase. What's the difference between private equity and venture capital? Venture capital is it's a commercial investment company. So they have this fund. They go find lots of accredited investors and even more wealthy people. They put money into that thing. And the general partners, our job is to go find companies like yours to invest in and create a return when the fund liquidates in 10 years or less. Private equity is a little different. It's basically, there are firms that do this as well, just like with the private venture capital. But it is kind of like much bigger dollar sign angel investing at the end of the day. These are individuals or usually groups of individuals, usually extremely wealthy, but not always, who we call it hunting in packs. So they all invest together. They co-invest because they all want to be supportive of the natural and organic product space, for example. So they have either themselves as individuals or in small groups. And this is what family offices do. And I was talking earlier about younger generations. They'll say, you know what, we've inherited $75 million and Dad always put it into the stock market, but I really do want to start doing some good in the world for me, feel good about managing this wealth. So I want to find companies like this and invest in them. Just like with VCs, not all money is the same. And you want to be able to find a big, experienced group of private equity folks that are at least committed to this space, ideally have done something entrepreneurial so that they understand not everything goes to plan. You need to have investors so that when it doesn't go to plan, you can call them and say, look, here's what's going on. Our projection said we were going to do this. Here's why we didn't, but here's what I'm doing about it. Here's the piece I'm not sure about. And by the time you get to this stage, PE and VC, you really need to be intentional about who your board and advisors are too. A board represents the investors in the company, first and foremost. Now, you as a founder are one, but they've got other people, all the other people that put money into your company, that board is legally obligated to watch out for their interests. A board of advisors is someone it's a group of people who are adding value by base of their experience. So if you're a CEO, and again, you're not sure, man, I just don't know how to think about when it's time to sell my company. You want disinterested experts doing that. And so find advisors anywhere you can. They could be VCs that just didn't invest in your company. They could be CEOs of one of your customers even. But all of that ecosystem will help you as you go through each of these stages I've just talked about, figure out when you're ready for the next one, which is the right financing tool for the job at each stage. Like, we're not the right financing tool for the job. Elizabeth has graduated from us. She's got $50 million now in equity. She doesn't need a, $4 or $5 million credit line anymore. So all of these things have a season in the life of your business. But just because VC is in the news all the time, that doesn't mean that's where you start. So be intentional about it. Understand these steps. In the case of this group this morning, I would welcome any of you, if you want to connect on LinkedIn. I would be happy to chat with any of you at any time if you've got a specific question. And again, remember, this is just Jim's opinion. I've been doing things a long time, but it's just one guy, so get lots of them. But I'd be happy to chat with you at some point. And at this point, actually, Christina, I never asked you how much time we have, but I guess I'm done, so I'm happy to answer questions. And if there's things I didn't touch on that you want me to, let me know. I tried to cover the landscape at a pretty fast pace.
Yeah, no, I think we're hitting a good time here. And I just want to reiterate a couple of things that I've also heard over and over my whole life, which is ask for advice, not money, because asking for money just gets you advice. Don't wait until you need money to start building those relationships. Sometimes as a founder, you feel like, oh, I'm not ready for anyone to see what I'm working on. My pitch deck isn't perfect. So what? They want to see your progress, because watching you progress builds trust. And it means that you are committed to what you are doing. So share those small wins. You don't need to wait for a big win to share that with an investor. I think, and I've said this in this program a few times now, people invest in people that invest in themselves. And so you need to celebrate those small wins and share those with your community, because that's really what you're doing, right? You need to create a community around your business. So I'll open it up with questions here. I know, this topic has been, a lot of you have been requesting and excited for this conversation. So who wants to go first? I see a question in the chat here. How do we seek out advisors? Where do we start? For us, racing comes with finding advisors who can guide us through spending so we can scale in the best way possible.
Well, you're doing the first step right now, which is you're getting involved with groups like Naturally Boulder, Naturally Boulder. We have Naturally Boulder too, but Naturally Austin. And there's a network there. Just ask people like me. I gave you one suggestion with Andy Whitman. I'm not saying he's got the time to be everyone's advisor, but he will absolutely look at your company and he'll tell you you're not ready for us yet. Other ways to do it is you go to things like Expo West, meet fellow CEOs doing what a little farther down than you were, ask them who advised them. If you are, and read all of the trades, so whatever you're reading in your particular niche within natural and organic, there will be people who are either interviewed or are writing articles occasionally. And they are often people who have run these companies, are running them, and ask them. If you've got a company that you kind of benchmark, like you're doing, it could be anything, you're doing peanut butter, and there's somebody who's done a version of peanut butter that is 3 years down the road farther than you are, or maybe if that's a competitor, something in an adjacent space and not a direct competitor, call that CEO and say, you know what, I'd like to include you as a sounding board as I talk this through. And sometimes an advisory relationship doesn't have to be a permanent thing. Sometimes you just need an advisor to figure out when you're at this next step change in financing. But otherwise it's basic networking. I think that the basic way to do it is always be curious when you read something, when you meet someone, not just, okay, that's cool what you're doing. Is that an experience that I'm going to need to learn from so I don't have to do the same mistakes? We created this whole financing structure I told you because we all learned the hard way what happens if you sell equity too early or something like that. So find people that have done something and learned a lesson and then learn on their dime. Otherwise, there's
Christine?
not magic to it. It's just networking. Angel groups, though, I would say you will, if you start there, if they're any good as well, they can probably connect you with some people who've done a similar company and would love to be a mentor. I do some of that with the Rockies Angel group here.
Go ahead, Christine.
Okay, I had a quick 2 questions. The first was for VC, mostly VC money, do they only do like equity financing, or are they ever open to convertible debt? And so that's the first question.
There is a hybrid, and frankly, it's kind of loosely defined. We did it once. It's called venture debt.
Yeah.
And so there are some that will do it, but I think the same caveats I gave before apply.
Yeah.
It could or could not be a good idea for you, but you really do want to get some outside advice as whether these terms are going to be good for you in the long term as a founder. I think of everything I talked about, the only one I would steer away from, and again, this is just my opinion, and remember, I sometimes compete with these firms, but there's merchant cash advances, or MCA debt. And the way that works, it's very easy to get in and out of, tends to be quite expensive in terms of the interest rate, and they basically connect to your receivables and they claw your money out of your bank account. Now, it is, sometimes you got to do what you got to do, and they do, but they will often let you borrow for specific purposes. There's companies online, you can sign up and you get a $250,000 loan, but it can only be used for marketing or things like that. I would steer away from that, frankly, if you can avoid it. We're actually refinancing people that got underwater with that right now. So, that's kind of off tangent, but venture debt, frankly, I'm not an expert in it. I've never seen it be that compelling. I think there are some VCs that do it. I don't know any. It tends to more be kind of hybrid lenders that do other kinds of equity. VCs, I'm sure there are. I just don't know them.
And then one other question is I see, at least in like our competitor kind of landscape, people do multiple pre-seed or seed rounds. So it'll be like, $1 million pre-seed, 2 million pre-seed, 1.5 million pre-seed, and then jump to seed, same type of thing. What is your, I guess, opinion on breaking up raises in the same category?
Well, the plus side is, you can look at that 2 ways. One is, I am being intentional and I'm only selling as much as my company as I need to do now to get to the next step. If you're doing that as part of a strategic kind of plan, that I'm going to do this, and then I'm going to see whether I can either organically fund or whether I need to do the next thing. That's probably okay. I see companies doing exactly what you described, also because their projections were crap at the beginning, and they literally, it's taken 5 times as long. If you don't want to fall into that trap, and this is one thing I've learned the hard way, everything will take much longer than you think most of the time. Everything will cost more. Budget for setbacks. You may lose your first customer halfway through all of this. You have churn. You got to plan for churn. You may have a key employee who had the entire marketing plan between her ears and she leaves, or so you have to, the wisest that when I think I told you my first company, the initial PE investor was a very wealthy guy in London, actually. And if you find a good investor, listen for these words. One is they will tell you whether you're taking too much or too little money. I went to him, and it's just this long time ago, but I think I was asking for $1 million. And he said, I'm not going to give you $1 million. I'm going to give you 2, because the worst thing I could do to you is give you half of what you need to get to where you're going. They should be looking at it with that lens. Now, they may want you to take more of your company too. By the same token, they may say, the worst thing I can do for you, and especially guys that made their money being entrepreneurs or women that did, will say this: I know this seems cruel. The worst thing I can do is give you $2 million right now. You are not at a stage where you've got your plan in place to do that. And I'm not saying that you're going to be a fraud or you're going to spend it all on plants for the office, but it's going to distract you because that money's got to go to work. What you need to do now is focus on getting all the basics right, your team finished and your product certified and all of these things. So a good investor partner for you will talk in that language, I think. And I've
Jim,
actually
and I
forgotten what
think
your question was. Did I answer it? Okay.
Yeah, you
Jim,
did. Thank you.
Jim, when you said, if it's a founder, that's a great time to ask for advice, right? If they're going to
Yeah.
tell you, if they see something that you don't, if they tell you something like that, ask what it is, get specific about it. Don't waste any of those conversations. And I know Connie had a quick question in the chat about advisors looking for equity. Is that something that you would advise? Is that the norm? What's your experience with that, Jim?
Do you mean firms that will basically consult to you and make the connections with investors? Is that, I'm not sure I understand the
No,
question.
this is tagging on to the question about the advisory board. How do we seek out advisors?
Mhm.
Yeah, and so I'm wondering if we're doing it, if they're just doing it out of goodwill, and I'm kind of hesitant to ask them because are they in the back of their heads looking for equity in the long run? Does that make sense? Yeah.
Well, you want to, you know what? And then this was said on this call yesterday, and I agree with it completely. I think Isabella said this. Trust your intuition. Some of them are. Now, that's not a bad thing. And maybe they're kind of testing you out too. They go, you know what? I think Connie's great. She seems like, smart and passionate about what she's doing. I want to just give her she's asked for the benefit of my experience for a couple of months. And, if I like what I'm seeing, maybe I'll join the round when she does it. But you don't want to blur those lines. That's why I said, think about advisors differently than you think about your board, because your board's primary job is to manage the risks and opportunities for people who've put money into the company. It's not you as the CEO. The board can replace you as CEO. So you want to either keep control of your company, or you want to have a board that you're aligned with in terms of what you're all doing there and that are going to help you succeed as a CEO. A good board member will always know their first job is to pick the CEO and support them to succeed. That's their primary job, actually. An advisor has the freedom, because they don't have money in the company and they don't have the official fiduciary responsibility of a board member. They can sit there and tell you whatever they think. Kind of like I'm doing with you guys now. I've got opinions about some of these things. You don't have to listen to me. And I have no reason to try to sell you anything or tell you, you're all too early for my company right now, I think, anyway. I mean, you might not be in a few months, so call me. But I think you want both. You really need those perspectives. And in advisors, think about it in two categories. One is they did something I admire. I want to be that. I want to do that. Or they solved a problem that I know I'm going to have, and I want to hear how they did it. There's a third kind of advisor too. This is a little more on the soft side of things. But being an entrepreneur and a founder is really hard, and it is all consuming. And you need to take care of yourself. You will be a better CEO if you, and I'm terrible at this, by the way. So this is the worst guide. I learned this the hard way. You have to also find people that have done your journey as a leader, because it's going to change a whole lot. If you're successful along all those steps that I said, the job will be almost unrecognizable. You'll be doing the worst way you can impair your company is 2 years from now. If you find you're still doing everything, you've screwed it up. You increasingly, as a company gets bigger, you're affecting how the company does through others. There's a you probably know this firm in Boulder, probably the biggest known private VC firm is called Foundry Group. And I would encourage you to read every book that Brad Feld or Jason Mendelson, the four partners over there, they are all huge supporters of entrepreneurship. They wrote books about this entire journey. And Brad Feld, one of the partners, always says a CEO ultimately has only 3 jobs: sell the mission of the company to every stakeholder. So every employee is aligned, every investor, the market, everyone knows what the product is and why to buy it. 2, put the right butts in the right seats. Find the right team to master everything. They should all. Steve Jobs was right. You hire smarter people than you to tell you what you don't know and what you should do. And 3rd, don't run out of money. That's all a CEO ultimately does. Now, right now, you're doing everything, but you should see yourself evolving along that journey as your company grows. So where I'm going with all of this is there's a 3rd kind of advisor, and that is a CEO coach. And the coach doesn't have to be a formal guy who's selling you consulting services. It could just be a CEO that you admire and trust, and who is authentic enough to tell you when you're wrong.
So
Those are the
Adi?
kind of advisors.
Hi, Jim. So along the same lines of what you just said about the third advisor, and it also in the beginning that they will be the one to tell you, hey, you don't need 1 million, you need 2 million. Now, as a founder, what are the right questions that we can ask them to almost kind of, before we have established that relationship? Let's say I'm meeting you for the first time and you're, I'm pitching to you, but also I'm very curious to know if you're the right person. What are the right kind of questions we can ask?
What kind of investor are you talking to at that stage?
So if I can apply it to our current situation, we're looking for angels.
Okay. So with angels, and I think, I can't remember, you have to remind me, Katrina, the angel investor that was on yesterday, I think he mentioned this, is communication is important, because remember, there are professional angel investors, like the guy on the panel I was on yesterday, but there are also, for every one of those, we
Dabblers.
call them dabblers. Now, that's not a bad thing. I mean, that's not what I am, but what that means is they're not a full-time professional investor. They're doing this because now they're either retired or they're wealthy enough that they don't have to work, or they still work, but they want to make small investments. Understand, if it's someone that's more on the dabbler side, you got to have a frank conversation about what your expectations are. You're not on my board, guy. You gave me 25 grand along with 5 of your friends who also gave me 25 grand. And by the way, these are the size investments they often will do. It's not $3 million. And so they sometimes, and I've had investors, I have some now, like this, they'll want to call you every week like a board member would and say, okay, I want to get an update on the projections. That'll eat you alive. You can't do that. So this is why I say go through a group, because a good angel group will have kind of structured that. Say, okay, if you're going to invest in our club, here's how we communicate with our portfolio companies. We call them in every 90 days for an update to the investing group. That kind of thing is manageable. But you get more than 4 or 5 people all calling you up all the time or having an opinion about how you do stuff. They're not board members. They don't have that responsibility, and they think they do. So that's one thing you want to get clear about. 2, ask them about investments that they've had that have gone well and they've gone poorly, and why.
Got it.
3rd, these are basic things, but say, all right, what's your objective in doing this? Do you want to be out of it again in 6 months? What kind of return are you expecting? And if he says, well, I want to quadruple my money by June. So, well, this is probably not the thing for you to do, because I don't have any money yet, and I'll still be figuring out what I'm raising in June. So it's basic things like that. So much the better if the person who's an angel is doing this had been an entrepreneur at some point, because at that point they may actually be a resource for you, and almost one of these advisors say, I know you built your fortune by running whatever it was, a drugstore, and how'd you raise money? Why are you doing this? You got to know them as people. Yeah. You're not talking about, it's huge dollars to you. It's not huge dollars in the life of your business ultimately. Yeah. And so keep the relationship proportional that way. When a VC invests in you, yeah, they're going to be on your board and everything else, but an angel isn't. And some of them are confused about that.
Got it. And
so last thing I would say, and this came up yesterday with the gentleman who's a professional angel investor, is a good one who understands, and this is true of any of these levels in investing, they will almost quote back to you, okay, you're in this category and you're saying the addressable market's this, I know it's that, so you've got to have that stuff mastered. And you want to make sure they understand the question you're asking. Sometimes they've just been told to ask these things and they don't really understand it. You want an investor who really does.
Yeah.
And learn from every turn down, by the way. I think Katrina was saying this earlier. Every meeting is a chance to learn. So when you get a no, say, all right, tell me what about this was no.
Yeah.
I'm not trying to change your mind. Sometimes they'll say you're just not ripe yet. Come back in 6 months and you fit our definition of where we invest.
Right. Yeah, well, I was just talking to somebody not too long ago, and the conversation was going really well, but very quickly the gentleman mentioned, I don't believe in shipping liquids across the country to get the product to the customer. So that's when I really understood that the money aside, his idea and what we're building, it does not match. So it's never going to be a healthy relationship. So another question is, what advice would you give for a company like when you know you have really good traction, and how do we just take this and blow this up?
What does your company do?
Yeah, sorry. We are in the chai and coffee space, so we make authentic chai here in the United States. Something that, in fact, there's a very popular company out of, I believe they're out of Boulder, if not, they're in Colorado, called Bhakti Chai.
We funded them when they started.
Oh, that's fantastic. I would love to, chat more with you about what Bhakti had done, or what anyone else in the chai space has done, and what we're doing differently, and why it's better.
It was before I ran this, but the woman who ran this company before me did that deal. So we can talk afterwards, and I'm sure she'll give you insight.
Yeah, would love to. So that's what we're doing right now, is chai and coffee, and we ship nationwide, and we also have a great deal of wholesale customer base in Austin.
Okay, and so you blow it up is a very vague term. What is your specific objective right now?
The objective is to make the name of my brand is Kimbala, and to make it the chai brand of the United States.
So that's a multifaceted thing. Some of that's not about money. Some of that's about marketing and positioning and everything else. But if what you're saying is that you have you've demonstrated that there's a market for your product, your trends are all going in the right direction, you're getting more shelf space and wider geographic distribution and everything else, then to me, the pitch would be, okay, I grew up in Michigan, so a lot of car analogies in what I talk about. So right now, you guys are working on a small one-cylinder engine. And you get enough money and you add one cylinder, and now you've got enough for a lawnmower. And then you get a four-cylinder. By the time you get a four-cylinder engine, it's not powerful enough to do what you're trying to do, but it is running smoothly. And it is actually running a little faster every minute as I step on the gas. I don't have enough fuel in the tank to make an 8-cylinder. Yeah. The pitch to the investor is, all right, I already have the team I need, except, I now need a Fortune 500 marketing person who wants to go be entrepreneurial and help me with this, because now that's what we're talking about. But what I'm basically doing is I need to make the engine that I'm perfecting bigger. And secondly, I also think that in addition to a gas engine, this thing could be a hybrid, because there's extensions to this. That you're asking someone then to simply invest in making what you're doing succeed more, as opposed to very early stage where you're saying, I need some money to figure the rest of this out. That's what seed is for, and some of those things. So what you're describing, if you're, and we can talk offline about numbers and things, but depending on what those numbers are, yeah, you probably are looking at pitching VCs, like my friend Andy at Whitman, that's the kind of thing you would do. You could, at the stage you're describing, you're past angel investing, and but here's the thing. Never rule out credit as well. That's what I've learned running this business, right? Because I didn't run a credit business before. I've done a lot of entrepreneurial stuff, but unlike in our personal lives, where you guys are probably all putting stuff on your credit cards now to make your business go, everybody does, but ultimately you don't want to be doing that. In a business, credit is always an important part of your credit stack, because you're going to be profitable and then bankable. You're going to have a relationship with a bank.
Yeah.
They will extend credit to you. And that's what allows you then to say, you know what, I need to open 3 distribution centers in California. You have the financing in your pocket to do that. That's what credit's for. It's so that you know ahead of time. You can't be constantly raising equity. You'll do nothing else for the rest of your life. So you probably need to look at your banking relationships. If you're not yet profitable, you need to look at a firm like mine that can still give you millions in credit. That's what you got to do.
Yeah.
But I think from the little I know, yeah, you're probably at a point where you're starting to pitch VCs if you haven't done that.
Yeah, I haven't approached any VCs. It's just been a few conversations, really. In fact, the pitch deck is not even fully ready yet.
Okay.
But
Well, that's job one.
yeah, that is, I completely agree, but I would love to chat with you offline.
Yeah, just ping me on LinkedIn and we'll figure something out.
Will do. Thank you so much.
I just dropped Jim's LinkedIn in the chat, and I know we are now out of time, but I just want to build on something that Jim said, because this point has come up a few times in our MO classes, also in the past, which is when you're working with an angel, you also want to find out how much their total allocation to investment is. So, and their net worth, right? And so, for example, if somebody's worth $1 million and they're trying to write you $100,000 check, that's a lot of expectation on return, because that's a lot of pressure for them. And so you also want to make sure that you understand that piece, and how much they're investing with you is at a size that is manageable for them and their expectations. So that's
That is
also
a hugely
just a really
important point. I'm
thing to
actually
understand.
living that now with a company that I'm involved with, where there were people, I mean, yeah, they're accredited investors, but they frankly, what the hell were they thinking? They put way too much money into this thing and it lost money, and they just freak out. And you got to understand, you're investing in entrepreneurs. You're going to lose some money. You just do.
Yeah.
Last thing I'll mention is I am actually flying to Austin for the birthday bash. So if we don't connect up before that, snag me while I'm there.
Awesome. All right, so we will see you guys at the next class. Thank you so much for your questions and time. Jim, thank you so much. This is so many great insights here, and you've been very generous with your time. So really
you're
appreciate
welcome.
you.
I enjoyed it. Thanks, guys.
Thank
Good luck.
you. Okay.
Yep. Bye.
Thanks, y'all. I'll drop all of these other things that I threw in the chat in our Slack channel so we don't lose it.
Perfect.
Okay, bye.
Bye.